Hey, what's going on, everybody? This is Kenyon Hackworth from Healthy You, Wealthy You. Listen, make sure you like this video and subscribe to the channel and comment down below. Today, we're going to talk about this market sell-off. As of today, the market is currently down around 16% for the year. And at one point, it was down greater than 20%. Now, if the market closed this year down greater than 20%, that would mark only the third time in the last 47 years, since 1974, that the market closed down greater than 20% for the year. And if it closes down greater than 10%, this will only be the fourth time since in 47 years, counting 2001, 2002, and 2008, that the market closed down greater than 10% for the year. Now, while some people freak out and get upset about the decrease in the value of their portfolio, for the long-term investor, this presents a tremendous buying opportunity to be able to buy some of the greatest companies at discounts. Now, I'm going to use two examples of the two recent market sell-offs, and just to show you how buying shares at different times during a sell-off can be beneficial for the long-term investor. The first time frame I'm going to use was the sell-off that happened between October 1st, 2018 and December 24th, 2018. During that 3-month period, the S&P 500 of the market was down roughly around 19%, and my portfolio was down roughly around 22%. So I used that opportunity to buy a couple of companies during that time frame. One was AbbVie. As you can see here, I ended up buying on 3 different occasions, a total of 71 shares for a total of $6,071.93. Also during that time frame, I bought Alphabet, or the parent company of Google. So at that time, I bought 5 shares. The price of Google, I'm going to say Google at that time because everybody's familiar with the name Google as opposed to Alphabet. So I bought 5 shares of Google. The price was $1,091.66 for a total amount invested of $5,463.24. The second time frame I'm going to use was the COVID pullback in 2020. And that lasted roughly around 1 month, from February 21st, 2020 to March 23rd, 2020. So at that particular point in time, my portfolio was down roughly 33% in that time frame. And that temporary being down 33% did not cause me to panic. It did not cause me to pull out my shares or want me to go and sell my stock because everything was going to go haywire or whatever. But during that pullback, I bought 16 shares of Broadcom. Broadcom is a company that I absolutely love. At that particular point in time, those 16 shares of Broadcom cost $2,902.19. That was the amount invested for that particular aspect of it. Now, if you fast forward to today, now I have not sold any shares of any of these companies. In fact, I don't buy stocks to sell. I don't buy stocks. I don't trade options. I buy fractional pieces of businesses to own, and my family, so my family can own these businesses for a multitude of years and reap the benefits of this tremendous power of compounding. There is no greater force to building wealth than time plus the power of compounding if we plant our seeds in fertile soil, get out of our own way, and just let our money grow. So here, if you look at this particular chart here, I'm going to go through it little by little and show you what happens just from buying the companies and just letting them grow. Now, in the first column here on the left side, you see the name of the companies: AbbVie, Alphabet, which is Google, and Broadcom. It also shows you the year-to-date return. So this is the price appreciation or depreciation year-to-date. So AbbVie is up 19.04% year to date. Google is down 30.28% year to date. And Broadcom is down 17.19% year to date. Now, a company being down in the short term does not mean all of a sudden it's a bad company. Just because everybody else starts selling off their stock doesn't mean that I or you or anybody else should start selling off your stock, especially if you bought a great business. There's no reason to sell a great business because of the compounding nature that happens. All right, so going across here, you see the shares, 71 shares for AbbVie purchased in 2018. The average cost of those shares were $85.31 for a total amount invested, again, $6,071.93. Google, 5 shares. Now, Google did a 20-for-1 split, so that means that the number of shares increased by a factor of 20 and the price decreased by a factor of 20, but the value stayed the same. Nothing changed with the value of the company or the value of the shares. So the 5 shares, which were average cost of $54, which is now 100 shares, average cost of $54.63 for a total amount invested $5,463.24. And then Broadcom with those 16 shares, average cost $181.31 for a total of $2,902.19. For a total amount invested for those 3 companies, $13,460.34. So as of November 30th, 2022, the price had appreciated for AbbVie from the cost basis of $85. So now the current price was $161.18. So now those shares are worth $11,443.78. So it's grown by $5,371.85 for a total growth amount of 88.47%. Google, the current price of Google, $100.99. So the total amount of those 5 shares, which is now 100 shares because of the split, is $10,099 for a growth of $4,635.76 or 84.85%. And Broadcom, bought in 2020. The current price, that's a tremendous gain because Broadcom was bought at a tremendous discount when it sold off during COVID. So now those 16 shares at the current price of $551.03 or valued at $8,816.48 for a total growth of $5,914.29 or 203.79% growth. All right, so the total of those 3 companies now is $30,359.26 in market value for a total growth of $16,898.92 or 125.55%. Now, I have no intention on selling any of these companies anytime soon because I will still benefit from this tremendous power of compounding. Just like I've owned them for the last 4 years, or I'll actually own them a little bit longer, but 4 years, and the money has compounded. When you own a great business that's continuing to earn money, and all you have to do is own it. There's nothing that I have to do for any of these companies but allow management to run the company and to allow my money to grow. There's nothing else to do. There's no easier way to do it than to buy great businesses and leave them alone and let them run. Now, from here, we're going to talk briefly about the dividends. I don't want to go in this in too much detail because this is a whole nother 35 minutes or hour if I sit and talk about these dividends. But when I first bought AbbVie in 2018, or when I bought AbbVie this time in 2018, AbbVie was paying $3.59 per share in dividends. So the income for those 71 shares was $254.89 per year in income. Google does not pay a dividend, so there's no dividends for that. Broadcom, the dividends per share in 2020 were $13 per share. So those 16 shares, the income was $208. So the starting income for these particular companies was $462.89. Now, AbbVie started off with a yield at that particular point in time. The yield when I bought the shares was 4.21%. And the yield, think about yield, is what percentage I'm being paid in income based upon the money that I invest. So on the $6,000 invested, I'm receiving 4.21% in dividend income. And for Broadcom down below, because of the sell-off, its yield reached as high as 7.1%, 7.17%. So on that $2,902, I was receiving 7.17% per year in income going forward. Now, if you fast forward to today, currently, AbbVie's dividend income has increased because it's increased its dividend every single year. AbbVie was spun off from Abbott Laboratories in 2013, but dating back to the time it was part of Abbott Laboratories, it has increased its dividend for over 50 years in a row. So here, it has increased the dividend from $3.59 up to $5.92 per share. Broadcom has increased its dividend from $13 per share up to $16.40 per share. So correspondingly, you can see the growth of the income. Now, this is just assuming that I have not reinvested any dividends, but I can tell you that I always reinvest my dividends to buy new shares. So the income would actually be more counting the reinvested dividends over the course of these years. But just counting these 71 shares of AbbVie, now the current income would be $420.32 as opposed to $254.89 when I first invested in it. Broadcom is now paying $262.40 as opposed to the $208 when I first bought it a couple of years ago. Now the current income for these particular shares is $682.80, which is a difference or a growth of $219.91 per year in passive income, or 47.51%. Now, there's this thing called yield on cost or effective yield. And yield on cost is the yield I'm being paid relative to the dividend increases in regards to the initial price that I paid for the shares. So, for instance, AbbVie, when I first bought it, the starting year was 4.21%. Because it has increased its dividend to $5.92, so I take $5.92 divided by the average cost per share, which is $85.31 times 100, and now I am being paid roughly around 7% per year in dividend income based upon the original purchase price. Broadcom, the yield on cost is 9.04%. So the $16.40 divided by the original price, $181.38 times 100, gives me a 9% yield. So because of the company increasing its dividend, I am now receiving 9% per year in income on the original purchase price. So another reason why you buy great companies that grow their dividends, you can receive a tremendous amount. And that's why I don't buy fixed income instruments. I don't want to receive 5% income for 20 years. When I know that as the dividends continue to grow, so too does the yield based upon the price that I paid for it. And you can see now that the current dividend yield, if I were to buy shares today, the current dividend yield for AbbVie is 3.67%, and for Broadcom is 2.98%. So there's something that I get into later on with how to use the dividend yield and when the dividend yield rises. So when the stock price goes down, the dividend yield goes up. So sometimes you can use the dividend yield to determine whether or not a company is undervalued or is cheaper. And when the stock price goes up, the dividend yield goes down. Also, when a company increases its dividend, the dividend yield goes up. So the objective is, when you're looking for creating a stream of passive income through investing, is getting a great mix of starting dividend yield plus dividend growth. And that's really what's important. So you have this opportunity to buy these shares at great prices. So this time around, you pretty much had almost the entire year. It's still going on when you can buy shares at really good prices if you're buying great companies. Now, if you're chasing hot stocks or looking for companies that you think are going to run up to some crazy amount over the course of 6 months, then you're going to be finding yourself in a bit of trouble. I have no idea what the stock market is going to, and neither does anybody else, by the way, what the stock market is going to do over the course of 3 months or 6 months or 1 year. This could go on for the next 3 months, or it can go on for the next year. Who knows? But I know that if you continue to buy great companies at great prices and you hold them and you allow them to compound, then 5 years from now, 10 years from now, 20 years from now, you will benefit tremendously. Tremendously. You and your family will benefit tremendously. So learn how to look for great businesses to buy and to own. You don't have to trade in and out of stocks. That's the worst thing that the average person can do, spend their time trying to trade in and out of stocks. There's nothing I have to do for any of these companies. Just let them compound. As long as the fundamentals are good, I can just let these companies compound. That's it. That is the key. Find great companies selling at great prices, which there are a lot of today still, and just allow them to compound. Just allow them to compound. All right, so stay tuned for the next video, and we'll keep this going. All right, have a great day. Talk to you soon.